Yes, I know a lot of people are worried about all the AI hype, as we're looking to the future, especially with embodied AI, which is all about robotaxis and transforming the world of transportation completely, and then healthcare, which is probably one of the most profound applications of AI. We think that this investment will pay off, and I think the chaser is going to be humanoid robots. And I think that is going to be the biggest of all the embodied AI opportunities.
The frame is set by a simple claim that runs counter to the daily noise. The story here is not momentum for its own sake, but a transition from software in the cloud to machines in the world. Transportation and healthcare become the on-ramps, and humanoid robots arrive as the punchline that changes the scale. If that sounds ambitious, it is meant to be. The opportunity gets its shape when we follow where she says the growth actually comes from.
Yes, well, if we're right and the growth continues to accelerate in this space, we think that the that the valuations will make sense longer term. So you really do have to have a longer term time horizon, which we do. We have a 5-year investment time horizon. I'm not saying there will never be any corrections. Of course there will, as many people worry, okay, is this too much too soon? But if our expectations for AI, especially embodied AI in the way that I just described, are correct, we are at the very beginning of, a technology revolution.
Corrections are not disqualifiers. They are reminders to match horizon to thesis. A 5-year lens is not a slogan in this context, but a boundary that lets valuation math catch up to operating reality. When the focus is on acceleration rather than a single quarter, the question changes from whether a price is too high to whether unit economics can compound. If the answer is yes, volatility becomes the toll you pay to stay on the road. The narrative moves from fear of heights to patience with ramps.
I do not believe AI is in a bubble. What I do think is on the enterprise side, it is going to take a while for large corporations to prepare themselves to transform. It's going to take a company like Palantir going into the largest enterprises and really restructuring them in order to really capitalize on the productivity gains that we think are going to be unleashed by AI.
This is where hype meets plumbing. Before dashboards glow with new throughput, someone has to rewire the factory. The suggestion is that adoption is lumpy on the enterprise side not because the tech is thin, but because the scaffolding is heavy. Partners that specialize in reorganization become force multipliers. The near term looks slower by design, so the medium term can look faster by result.
In the consumer space, the consumer loves all of this, and I think we're all looking forward to our personal assistants doing our shopping for us. Well, I am. As I talk to people around the world, some people love shopping, so they may not. But I am really excited about not just shopping, but how much my productivity as an individual is going to increase with AI. It already has in terms of research.
If enterprise change is a marathon, the consumer side is a sprint. Assistants shrink errands and expand attention, and the first gains show up in simple tasks that add up over a week. Productivity is not a statistic in a government release here. It is a daily feeling of getting more done with less friction. That feeling is the demand signal that pushes the rest of the stack forward. It is how adoption jumps from early curiosity to common habit.
I think we're going to reach a moment in the next year where the conversation will shift from lower interest rates to rising rates, but it will be for a good reason. We think that the economy, the US and the rest of the world, of course, will participate, is going to move into a productivity-driven boom, just in time for our midterm elections. So I think when interest rates reverse, there will be a shudder, because there are a lot of people out there, and we saw this during COVID and its aftermath, who think that innovation and interest rates are inversely correlated. That is not true over history. Even in 2017, when interest rates went up, we had phenomenal performance. So I want to disabuse people of that notion, but nonetheless, the way algorithms work these days, we think that there will be a reality check, shall we say.
Macro jitters often flatten nuanced cycles into simple rules that do not hold up. If the driver of growth is productivity, an uptick in rates tied to strength can coexist with strong innovation returns. The warning is about the reflex, not the fundamentals. Algorithms can stutter even when the story is intact. Long horizon investors try to use those stutters to tighten their grip.
Well, one of the things we have focused on consistently is, really, this is going to sound almost silly, but we're focused on the future, and pure plays in the innovation space around robotics, energy storage, AI, blockchain technology, and especially multiomic sequencing in the healthcare space. I think that's the most underestimated and underappreciated. So those are our 5 main areas. They involve 15 technologies, and we think they're converging to create really explosive growth opportunities.
The map is not a scatterplot of buzzwords. It is a convergence diagram. Robotics needs cheap, dense energy storage. AI supercharges discovery in multiomics. Blockchains add transparent data rails where needed. When the pipes connect, the use cases multiply. That is what turns a theme into an ecosystem and an ecosystem into a cycle.
Yes, we went through a very rough patch, and in fact, during the 4 years prior to this administration, we were facing increasing regulation, a massive increase in interest rates, supply chain shocks, all of which impacted unit growth, and unit growth really drives innovation. And the faster units grow, the faster costs decline. And so we're through that.
Cycles cut both ways. It matters to hear unit growth named as the engine that pulls costs down, because it clarifies why slowdowns bite and why recoveries can snap back. If supply chains clear and demand returns, the learning curve steepens again. That is when new price points unlock new markets. Momentum, then, is not a mood. It is math.
In this administration, we have with OB3, the One Big Beautiful Bill, massive tax changes that are going to take the effective corporate tax rate in the United States down to what we believe is 10%. Statutory will still be 21%, but with the accelerated depreciation, massive accelerated depreciation in manufacturing structures, equipment, domestic R&D, and software, we think that that is going to turbocharge innovation in a way that people do not appreciate right now. And that is one of the reasons we do believe we're moving into next year. We'll see this idea of a productivity-led boom in activity.
Here the policy layer plugs into the forecast. Effective rates matter because they change hurdle rates. Accelerated depreciation shifts cash flows forward, which turns more projects from interesting to inevitable. When CapEx meets learning curves, the adoption flywheel spins faster. The claim is not that policy creates innovation, but that it can lower the friction for it to scale.
Yes, I do. I absolutely do. They're very focused on deregulation, massive deregulation. We have a crypto and AI czar. Never have had that before. And they are focused on business-friendly policies, inviting more foreign direct investment into the United States, especially in the manufacturing realm.
Credit spreads across cycles and parties in this telling. which underscores that the thesis is bigger than any single news item. The practical takeaway for investors is to watch for continuity in incentives that support build-out. If those persist, planning horizons lengthen and capital stacks get bolder. The opportunity then is not a fad, but a foundation. It is the difference between a story you rent and an infrastructure you own.
Well, meantime, let's talk about some big investments in tech as Cathie Wood's ARK ETFs made significant changes to their portfolios last week. According to daily trading disclosures, selling AMD and Shopify and buying Baidu. The China interest is part of a trend this year, with Wood buying Alibaba stock for the first time in 4 years last month.
Positioning is never static. Rotations within the theme reveal how conviction is expressed as conditions evolve. When a manager calls AI the beginning of a revolution and then reallocates among chipmakers, platforms, and geographies, it shows the thesis is live, not fixed. The story we are tracking is both principle and posture. It is a view of where growth will form and a set of moves to meet it. We traced a simple arc. Embodied AI sets the stage, consumer productivity offers early proof, enterprise transformation installs the wiring, and policy tailwinds lower the cost of speed. Along the way, rates may twitch and algorithms may flinch, but the core argument holds that unit growth unlocks cost declines and convergence multiplies returns. The rotations in holdings are the on-screen version of that view, shifting capital toward the pieces that can compound the next leg. Before we close, here is the thesis in its clearest form.
Is AI in a bubble right now?
I do not believe AI is in a bubble.
Do you agree that this is not a bubble, but the chance to own the rails of the next economy? And if so, where in this convergence would you place your first dollar today?